Welcome back to Talk Tickers. We're your shortcut to understanding what really matters from the latest corporate earnings calls.
And today, we're diving deep into the Q3 2025 results. We've got the numbers, we've got the management commentary.
That's right. And the headline from management was, a strong result in uncertain times. They really leaned on cost control and capital strength.
They did. Operationally, the numbers look, pretty clean, actually. But what really struck me was the market's reaction, or maybe lack thereof.
Yeah, the stock basically went nowhere, right, despite these seemingly solid results.
Exactly. It feels like the market is looking past this quarter and asking, okay, great, but what's next? Especially with interest rates.
That's the tension we need to unpack. Yeah. But first, let's quickly run through those headline figures because they do paint a picture of operational strength. What are the key takeaways there?
Okay, maybe 3 buckets: profitability, efficiency, and safety, let's call it. So profitability. GAAP EPS, diluted, was SEK 7.53.
Solid number.
And importantly, return on equity, ROE, hit 16.0%. That means they met their medium-term Swedbank 1527 target, which, it's 15%.
Hitting that ROE target is definitely a big tick in the box. So efficiency, how did it get there?
Well, that's the second piece. The cost-to-income ratio, CI, came in at 0.35, so 35%, which is, frankly, very, very good.
Yeah, that's pretty lean.
Definitely. And then safety or credit risk. They actually had a net reversal of credit impairments, minus SEK 398 million. That gives you a credit impairment ratio of negative 0.08%.
A reversal, okay. And the last piece, the capital foundation you mentioned, that was key.
Rock solid still. The CET1 ratio is sitting at 19.7%. Now, if you compare that to what the regulators require, it means they have a buffer of about 4.8 percentage points above the requirement. That's serious headroom.
Okay, 4.8 points is significant. We'll definitely come back to that. But let's dig into the income side first. Total income was SEK 17.1 billion, only up slightly, 0.8% quarter on quarter. That suggests some moving parts underneath.
Absolutely. The main story there is net interest income, NII. It actually dipped a bit, down 0.9% compared to Q2.
Why was that?
Mainly 2 things. Lower mortgage rates starting to bite on the asset side, and also the full quarter impact of some deposit rate cuts they'd already made. Volumes did help, though.
Oh, right. They had some volume growth.
Yeah, higher business volumes added about SEK 94 million positively in the quarter, but it just wasn't quite enough to fully offset that pressure on the margins.
Okay, so NII, the core lending income, was a bit soft. What stopped total income from falling, then?
The other lines picked up the slack. Net commission income, for example, was strong. That was driven mostly by asset management.
Rober.
Exactly, Rober. They saw net inflows of SEK 9 billion in the quarter. Plus, you had the usual seasonal boost from card commissions after summer spending. That helped cushion the NII dip.
Right, the summer holiday effect. Okay, let's circle back to efficiency. That 35% CI ratio is, as you said, really impressive. But how sustainable is it? Are they cutting corners?
Management pushed back on that idea pretty hard. They emphasized their focus on cost discipline to maintain that 35% level. They gave full year 2025 cost guidance of around SEK 25.3 billion.
Okay.
But, and this is an important but, that number includes about SEK 576 million in VAT recoveries they got back relating to 2016 to 2018.
So a one-off boost.
Kind of, yeah. It helps the number this year. They were very clear, though. They are not assuming any more VAT recoveries in that 2025 guidance. So the underlying run rate is maybe a little higher.
Got it. That's crucial for thinking about next year. Now, asset quality, you mentioned the net reversal. SEK 398 million. Does that mean credit quality is perfect across the board?
Not quite. The overall reversal was good news, driven by better macro forecasts and them taking off some of their own cautious overlays, these post-model adjustments.
Right.
But if you look at specific loans, individual assessments actually increased impairments by SEK 568 million. This was linked to just a few larger corporate...
So still some pockets of stress.
Exactly. It was just that this was more than offset by repayments and reversals elsewhere. But it shows you still need careful credit management, even when the headline number looks good.
Right. Okay. Operations covered. Let's shift gears to the bigger picture stuff. Governance, strategy. This felt like a quarter where they cleared some major hurdles.
Oh, absolutely. 2 really big ones. First, S&P upgraded their credit rating. And they specifically mentioned improved governance and risk management. That's a nice external validation.
Definitely. And the second one?
The big one. The U.S. authority, the SEC, officially closed its historical investigation into the bank's past issues without taking any enforcement action.
Wow. That's huge. That's been hanging over the stock for years, hasn't it?
It really has. It's a major de-risking event. You could almost hear the collective sigh of relief. It clears the path for them to focus more on the future.
Like M&A, for instance. They seem keen on that.
Very keen. They spent quite a bit of time talking about the plan to acquire the rest of Entercard that they don't already own.
Right, the card business.
Yeah. The goal seems pretty clear. Build the biggest Nordic-Baltic card platform. They're looking for bigger fee pools and, cost synergies down the line.
Makes sense. And there was another smaller deal, too.
Yes, taking a 20% stake in SB1 Markets. That looks like a move to beef up their offering for corporate clients, things like ECM, DCM, equity research, diversifying income streams, basically.
Okay, trying to get less dependent on just interest rates. Which brings us neatly to the elephant in the room, NII sensitivity. This seems to be what the market is really stuck on, especially with rates potentially falling further.
This is absolutely the core issue right now. Management confirmed the sort of expected dynamic. When rates fall, the benefit to their funding costs comes through faster than the hit to their lending yields. That's initially positive.
Okay, so far so good.
But, and this is the crucial update, their NII sensitivity overall is now tilted negative, meaning if rates fall further from here, the negative impact gets bigger faster.
What changed?
It's because some of their deposit rates, the rates they pay you for your savings, have essentially hit 0% commercially. They can't really push them lower.
Ah, the zero lower bound, but on the commercial side. So let me see if I get this for the listener. When central banks cut rates now,
Yeah.
the rate the bank earns on its loans keeps falling, but the rate it pays on some deposits is stuck at zero. It can't fall any further.
You've got it, exactly. That zero floor on the deposit side means the margin, the gap between lending and funding rates, gets squeezed harder and faster than it did when rates were higher, and they had room to cut deposit costs too.
Right. It's like one side of the vice can keep tightening, but the other side hit a stop.
Perfect analogy. That's why the market is so focused on this. It fundamentally changes the outlook for their core profitability if we see more rate cuts.
Which really underscores why they need that volume growth, particularly in places like the Baltics, and why the fee income from things like Entercard becomes even more important.
Precisely, to offset that potential NII squeeze.
Okay, which loops us all the way back to that massive capital buffer, 19.7% CET1. It's at 480 basis points above requirements. That is just enormous.
It really is, almost uncomfortably large for a bank that's generally been pretty disciplined with capital. Their official policy is a 60-70% dividend payout. And their target buffer is 200 basis points, right in the middle of their 100-300 range.
And they're sitting on 480, nearly 5%.
Yeah, exactly. Almost 300 basis points above their own target midpoint.
You'd think they'd be eager to return that. Special dividends, buybacks, something. But management sounded cautious.
They did. They said they don't intend to hold more capital than needed long term, but they pointed to other remaining U.S. investigations separate from the SEC, one that just closed, as a reason why the timing of further returns is still a judgment call.
Is that fully credible, though? After clearing the big SEC hurdle, it feels like there's some tension there.
There absolutely is. Holding that much excess capital comes with its own risks, like attracting activists or just frustrating existing shareholders. It's a difficult balancing act they're trying to pull off.
Especially when you layer on the fact that their costs are actually facing new headwinds from regulators, like bank taxes.
Yeah, that's the other squeeze. These sector-specific taxes are going up across their markets. Estonia, Latvia, Lithuania, Sweden.
The Swedish one is increasing.
Proposed to go from 6 to 7 basis points in 2026. And kind of adding insult to injury, there's a new Riksbank rule making them hold an interest-free deposit, about SEK 6 billion. That cost is expected to land on the bank tax line, too. So another hit.
Okay, so let's try and synthesize this. We have a quarter with, good operational results, key de-risking events like the S&P upgrade, especially the SEC closure, great cost control.
Right.
But overshadowed by this NII sensitivity issue because of the deposit floor and rising regulatory costs like bank taxes. And the flat stock price suggests the market is laser focused on that NII glide path downwards.
That sums it up perfectly. Near term, the stock's performance probably depends almost entirely on whether they can deliver on, 1, volume growth Baltic lending, maybe grabbing more Swedish mortgage share, and 2, making those fee initiatives like Robur and Entercard really work and deliver synergies.
But the ultimate catalyst remains that capital pile, doesn't it? When or if they decide to release it.
Absolutely. Which brings us, naturally, to our favorite segment.
Where we pitch an outrageous but plausible trade idea based on everything we've just discussed.
And let me just say very clearly, this is not financial advice. We're just thinking out loud here.
Definitely not advice. But if we're thinking out loud, you got this confluence of events. The big de-risking moments, S&P, SEC closure, smashing right up against this enormous 480 basis point capital buffer.
It feels unsustainable, right? That much idle capital after such positive news. The outrageous but plausible trade idea we kicked around was a capital arbitrage play.
Okay, how would that work?
You'd essentially go long the stock itself, betting on that capital return catalyst. But to maybe reduce your broader market or sector risk, you'd simultaneously short a regional European bank index ETF, something like the SX70 perhaps.
So isolating the company's specific factor, the capital return potential?
Exactly. You're betting that the pressure, maybe shareholder pressure, maybe just internal pressure to do something with that 480 basis points, especially now the SEC cloud is gone, becomes overwhelming.
The bet is the board feels compelled to announce a big buyback or a special dividend sooner than the market currently expects.
Precisely. You're betting the sheer size of the buffer forces their hand, maybe faster than their cautious commentary suggests. The market seems focused on the NII headwinds and lingering regulatory bits.
But it might be underestimating the sheer gravitational pull of nearly 5 percentage points of excess CET1 capital needing a home. You're trying to capture that value unlock.
That's the idea, capitalizing on that headroom before everyone else fully prices it in. It's definitely something to think about.
A provocative thought indeed. So to quickly recap, operationally a strong quarter, ROE target met, costs well managed, and that massive SEC investigation is finally closed.
But the market shrugged, worried about NII compression in a lower rate world, especially now we know about that effective 0% floor on some deposits.
Which leaves us with a final question for you, the listener, to ponder. Given that confirmed 0% floor, that reverse vice grip on margins, is management now implicitly, maybe even urgently, pivoting their entire growth strategy?
Are they aggressively shifting focus towards higher margin areas like Baltic lending and doubling down on fee income through M&A like Entercard, purely to counteract that inevitable NII squeeze? Is that the real strategic imperative now?
Something to consider as you digest today's deep dive. Thanks for joining us on Talk Tickers.
I'll catch you next time.